What is up, ladies and gentlemen? Welcome in to Oscar live earnings. What a morning we are having so far. I'm Ronnie. This is AC, and today we're going to get into all things Oscar health. Currently up almost 11% pre market after reporting some pretty stellar numbers, pretty insane numbers. We're going to break it all down, and then we have a little bit of time before we get into the earnings call. Once we get into the earnings call, we'll obviously be listening, and then we'll talk after that as well. AC, how are you doing? How are you, my friend?
Oh, it's a great morning. Oscar absolutely killed it in their earnings, and hopefully we'll be able to learn some more, most specifically around risk adjustment in their earnings call. But it was an incredible quarter. EPS was destroyed. Members less churn than initially expected, and it was a great quarter.
Yeah, I fully agree. If you want to go ahead and take the helm on um, talking about some of the things with Oscar, my live is not streaming to YouTube right now for some reason. So if you want to go ahead and kind of tackle some of the highlights of the quarter, um, I'd appreciate it while I
Of
get
course,
this
yeah.
under control.
So with Oscar's earnings, the just off the top line, we'll look over the first few, the main key items. First, total revenue. Now total revenue, what came in at 4.6 billion. Last year was 3 billion in Q1. The 4.6 billion is mainly driven by higher membership, but also the shift in members. Um, so when you're looking at the total revenue number, the revenue that's actually being reported is net of risk adjustment. So you bring in your gross premiums, which in this case was about around 6 billion in gross premiums. And then there was a risk adjustment hit of 23.9%, which ended up being 1.4 million. So you take the 6 billion minus 1.4, you get a rough amount of that 4.6. But most importantly, to realize is that because the risk adjustment was higher, it ended up having an interchangeable effect in the MLR. The MLR was much lower than initially expected. I know a lot of people were expecting 75. I was expecting personally 74.4. But because risk adjustment was higher, this meant that they had a lower than average risk score in the ACA marketplace. Paired with the price increases, they had a notably lower MLR, but risk adjustment was a little bit higher just because they were relatively healthier compared to the market. Now, when you're looking at the revenue first off, um, going forward to the rest of the year, since it is 23.9% in Q1, I do personally believe that this is going to fizzle down throughout the year, especially going into the end of the year. And I mainly say this as a percentage of revenue perspective because they're expecting churn throughout the year. They are pricing in based on their Q4 2025 earnings call, 1 to 2% churn on a monthly basis. And since you are kind of paying attention to 1 to 2% monthly churn when you're forecasting this forward, I did this on a monthly basis. So when we're looking at the risk adjustment as a percentage, it may be, 24% in the beginning of the year, but it's going to fizzle down as a lower percentage of revenue in order to meet their revenue targets. And that's kind of my um, consensus of what's kind of happening within this earnings and how they're going to be achieving that 18.7 to 19 billion on a full year. And another thing to note on that also is that as members slowly churn off throughout the year, assuming that 1 to 2% churn happens, is that they're most likely going to lose their healthier members, which is also going to help positively impact that risk adjustment. Most likely, just because they're going to have a higher average risk score, losing some of those healthier members, which is not a bad thing at the end of the day because they have had such high Q1 operating margins, just over 14%, which 14% operating margins in Q1 that's incredible. 70% MLR paired with 15.2% SG&A. That is just absolutely incredible numbers, and you absolutely love to see that for sure. Um, and having that 14% operating margins, how it works is throughout the year, it's going to go lower. And in Q4, we could actually see a negative operating margin or maybe even flat, just because the Q1 ends up setting the stage for the rest of the year. and that is where it kind of skews the whole number down. And then towards the end of the year, it skews it a little more towards that 2% or 3% margin on a full year basis. So very strong start to the year. And honestly, I wouldn't be surprised if we see 3 to 4% margins on a full year basis. Like this crushed everybody's expectations, and having a 14% operating margin in Q1, I really do believe that, closer to that 3% margin is going to be hit this year. And also in terms of membership, they did see 3.74 in terms of their membership as of March 31st, 2026. This was expected to initially be at 3 million. And this is a 170, almost 175,000 member beat at the end of Q1. So that is an incredible sign as well, coming down from 3.4 or 3.5 million at the beginning of the 2026, or at the end of the 2026 open enrollment period, which is very interesting. They were able to retain more members than they initially expected by quite a decent margin, just about what is that, around 5%, I believe. So that is just over 5%. So that is a very strong retention of members that you love to see. Another thing that I would like to point out too is that I went all the way down to the bottom and looked at their stock-based compensation. And their stock-based compensation is actually lower than the prior year. It looks like it was just about 25 million in Q1 of 2025, and only 15, just about 16 million as of Q1 2026. And that's quite significant, especially from a dilution perspective. Looking at just at their basic versus diluted shares outstanding. I was factoring in a full year dilution in my estimates of around 15%, which that is going to be, looks like that is what is going to be kind of hit. Right now we're at 298 million in terms of basic shares outstanding. It's put us at a basic 2.28 EPS, or $2.07 diluted EPS, which my EPS forecast was not far off. I was looking at the $1.07 EPS forecast. And, when I was seeing that, I was like, they're going to crush this EPS target. It is very low. It is not what it should be. And at the end of the day, we saw that massive beat. I was initially forecasting around $1.80 for EPS, and we came in 20 cents higher than that. So it was definitely an incredible quarter, for sure, across the board. And kind of the more I go through this, their financials, it is quite interesting. From a cash and cash equivalent perspective, first off, their cash cash equivalents went from 2.7 billion in Q4 2025 to 4.8 billion in Q1 2026. Massive jump in cash. Of course, a lot of that is going to be from having a major increase in actual premiums. Another thing is going to be when it comes to their payables to the CMS in terms of the actual risk adjustment. When it does come to the risk adjustment, it is currently sitting at 4.7 billion, up from 2.7 billion in Q4 2025. This payable is largely driven to the healthier shifted members, but also their risk adjustment payable. The way that the risk adjustment payable works is I believe it's finalized in June of the following year. So for 2025, it's completely finalized in June of 2026. And their actual payments don't go out until August 2026, roughly August 2026 for the prior year. So they have this whole increase in float, which is of course going to increase their short-term investments, but also increase their investment income, which their investment income came in at 60 million versus 46 million in Q1 of 2025, which is very interesting.
Yeah. Sorry, I changed my YouTube account to like a branded account, and so I had already scheduled my YouTube video to be played on YouTube right before I did that, and now it's now it like messed up, so I had to like start a new stream or whatever. But I'm getting it handled. That's what we do.
Yeah.
We get it handled. But yeah, man, just my thoughts about the quarter. I mean, I look at what management says they're going to do and then what they do. And right now, Mark Bertolini and team have been saying they're going to, get back to profitability this year. And to start with a quarter like this and blow everybody out of the water, like all analysts out of the water, I mean, me and you already know Mark Bertolini. We know his story. We know how he operates. We know, a lot about him, right? And we know when he says he's going to do something, like in that interview back in 2024 now, 2025 maybe, whenever he was talking about like getting to 3 to 5% margins and then doing about, 14 billion, which now they're doing well over 18, 19, right, billion in revenue. So,
Yep.
whenever he was saying those things about the margin, when you understand the man and you understand what he's done in his career and that he's a no BS type of guy, like you got to take him at his word. He's not going to be perfect because you can't control everything, especially in health insurance, but he's a very straightforward person.
Yeah, I was going to say too, everything operational, they crushed. Everything from an operational standpoint was crushed out of the water. Anything that really is hard is really not what they control. That was missed from a risk adjustment perspective. And it's very hard to, they have even mentioned it in their earnings call. It's very hard to forecast risk adjustment when risk adjustment is you're predicting your own book. And on top of predicting your own book, you are also forecasting and trying to predict everybody else's book in the entire ACA insurance market, which is the most it's very hard to do, let alone your own book, which I think Oscar personally has a pretty good handle on their own, just because of their advanced technology, claims data, all of their analytical processes on the back end has most likely been very almost spot on their side. But when you're looking at all the competitors, you know, it's not exactly as easy to do that. So like at the end of the day, from an operational standpoint, they absolutely crushed everybody's expectations on everything. Now, I will say from an EPS standpoint, now this is where I'm most excited. Analysts were expecting, I believe on Robinhood, it was a dollar and a penny EPS. They beat the analyst at EPS by over 100%, at $2.07. So I think that was just about the highlight of that. I got the alert because if you don't know, you can sign up for the investor relations emails every time Oscar has a SEC filing that comes up. So I have those newsletters on, and right at 6 a.m. is when they ended up posting their earnings results. And a split second later, I get the Robinhood notification. They beat it by like 100% or so in terms of EPS. Now, when you look at EPS, for example, and just from an operating earnings perspective, not net income, but from an operating earnings perspective, they had 704 million in earnings from operations. That is an absolute just killer result. And you know, having 3.174 million members versus the initial expected 3 million is surely incredible.
Yeah, I agree. Got the stream up, so we're good now. I cannot be distracted, and we can really get into this before earnings. Thanks for taking the front end of that and yeah, explaining all of that for everybody. Um, Diving more into the numbers, let's get away from like the highlight numbers, right? Because we can all see that, right? SG&A costs continue to come down. Medical loss ratio came down a good bit. And like you were saying, it does, it is typically lower in the beginning of the year and then kind of drifts up throughout the year. But what we really want to see is like between that 80 to like really sub 84 MLR ratio for the year is what we really want to see. If we can do that, then we will have a very, very profitable year. Free cash flow is obviously crushing it, and overall that net income and the bottom line and EPS will do very, very well as also. One more thing, the funniest thing, AC, and you have to agree with this. This stock was literally just like $11. It was just 11, or sorry, it got to $10.73. And we've essentially almost doubled in a month.
Yeah.
Basically a month, we've
Exactly.
almost doubled. AC, let's talk about this real quick. At $10.73, what was the market cap for this company? It was like what?
I think it was
Like three? Or like
it
a
was
little
around
lower
there.
than three, like 2.8, 2.9, right? Right? I think so.
Yes, yeah.
So were you not thinking this as well? This is what I kept telling everybody. I was like, you don't realize at a sub $3 billion market cap for this company, people didn't realize that the risk to reward was immense. Immense reward for little risk. Why do I say that? Because if you actually looked at their cash to debt position, if you actually looked at how much free cash flow this company could bring in, if you actually look at the assets that this company has, then you realize that at $10.73, this company could basically liquidate everything and have one solid year of free cash flow and basically cover their market cap. So basically, they're liquid. They could be liquidated and shareholders would get around the same amount of money back. Not $10 or $11. It'd probably be like $8 or $9. But that is what we call immense, like immense reward for a little bit of risk. You know what I'm saying? Were you thinking the same thing at that time?
I think my biggest concern at $10 to $11 was me not buying enough, to be honest. I just
True.
every single day, I just put my head down, bought more. Conviction was there, thesis was there. I did not the biggest thing, as you had mentioned, like the cash, for example, I believe their true cash position was around 2.5, 2.7, I believe. When you take all their cash equivalent, short-term investments, and you subtract their benefits payable, their true, I guess, comparable cash position to other companies was around 2.5, 2.7, just around there. And when you're looking at a market cap of 3 billion, their cash alone was almost that. And they're expected to grow on a full year basis 60 something percent revenue. Members increasing substantially from 2 million to 3.5 at the end of the open enrollment period.
Yep.
So I think at the end of the day, like my biggest concern was we're not going to be here for long once people realize what's going to happen in Q1.
No. And yeah, I mean, like the 2.3 billion in net cash and then the 1.1 billion that they can generate, it like you get to where they were or maybe slightly above where they were on their market cap. And those are opportunities that, like you said, AC, they do not stay around long. You need to be buying because they don't stay around long. And if you were a bull in Oscar, because I saw tons of people saying this name was going to go to 8 to 6 to 4 to 0. And those people just don't understand the numbers. They just don't understand math. Because like I said, how are you going to get there whenever the company becomes liquid? When the company sits there and you have enough cash and free cash flow to basically pay out all the shareholders what they like slightly less or slightly more than what they actually paid per share if they were to go belly up and just be done. So absolute nonsense. It's hilarious that people were thinking that. I posted this. I don't remember. I posted this after we started moving because we got a bull trigger on the daily, and then as we started moving, right, it, it's just so funny. It's just so funny, man, because on a technical standpoint, and we'll get more into the numbers here in a minute, on a technical standpoint, Oscar has followed, and I know it's a little bit messy, Oscar has followed this same pattern over and over and over and over again. Back here in 2021 to 2024, we consolidated. We consolidated for a long time. We broke out of downtrends and we went on a run. We broke out of downtrends and then we went on a run. We broke out of a downtrend. We went on a run. We broke out of a downtrend. We're going on a run. So last month or so, I said, hey, as soon as we broke this downtrend at like 13, 14 bucks, which we're now at $20, I said, yeah, we're following. I think you remember I said, I have something huge for shareholders. And it's not what they thought I was going to say. They thought I was going to say like something fundamental wise or like groundbreaking for the company. But I said, this technical analysis setup is like massive. And it shows you, hey, there's a pattern here. And sure as shit, look at us now. We're all the way up here. We're almost to the top of the range. Now, based on what they're doing, like this top of this range up here from like 22 to 24 is still very, very stiff resistance. You can agree with that. When and they like them breaking through this L resistance here at like 18, as long as this holds, right? That's very huge as well, because this thing is just very, very stiff. It's been rejected here multiple times. But if we're able to get through this and hold, which based on the numbers here, we definitely should be able to, right? They doubled their EPS. They missed on revenue, but like we were talking in the pre-show, I don't give a damn about the revenue. This company has exploded their revenue. Exploded their revenue, guys. Let's talk about this. This company has gone from 5.9 to 9.2 to 11.7. Let's drop this on a quarterly basis. All the way to 4.6 billion just last quarter. So on a trailing 12 month, 13.3 billion. And what did they guide? They guided what, 18 to 19 billion for this year in revenue?
18.7 to 19, yep.
Yeah, 18.7 to 19 billion in revenue. So they guided a massive revenue jump. 11.7 was 2025. Now they're guiding basically almost double their revenue. Guys, if they miss on this revenue, I really don't care, as long as they're coming in with EPS beats, net income, free cash flow, so on and so forth. That's what I really care about. So overall in the technicals, we still have room up to 23, 24. And the final thing that on the TA front before we move on, when we finally do break this $23.78, $24 range, like we're going to go absolute gangbusters. I mean, we're going to go to 30 and then we're going to go to 40 probably very quickly. This is like no man's land. There's no resistance up here. There's no support. There's no anything. It's no man's land. And this is what I've been talking about for a very, very long time. And it's funny because if you know, like we were talking about earlier with the comments, when we get up here and I'm like, you know, let's go, like we're bullish, it's time, and then we reject, and then we get up here and then we reject, and then we get up here and we reject. You know, people get recency bias and then they start to become non-investors in the company, right? Believing in the company, they start turning into more so traders. And it's like, I'll buy here, sell here, buy here, sell here, buy here, sell here, right? And like, that's great and all, but if like you want to be invested in Oscar, I wouldn't be doing that. I would definitely be buying down here, but I definitely wouldn't be selling up here, besides maybe trimming a little bit, because one of these times we are going to break out. And when we break out, you're going to look back and you're going to say, I sold at 24 and now we're at 30, 40, 50. Because this company can do that very, very quickly. Back into the earnings. Besides the main numbers, I mean, besides revenue, if people want to nitpick revenue, like, okay, like again, they're guiding for 18.7 to 19 billion. I'm totally good with them missing on revenue. It's whatever. I care about medical loss ratio. I care about SG&A costs continue to come down. I worry about net income and earnings from operation. I worry about EBITDA. I worry about the EPS being positive on a GAAP basis. Membership growth. I worry about making sure that that's not declining a ton. Do you have the number off the top of your head? Because I know they were in the last earnings call that we talked about. Um, they did they had a massive membership growth. I can go back and I don't know if you have it on hand. I don't. They had massive membership growth, and then they obviously said, "Hey, we're going to see a decline for the first quarter."
Yep.
Do you remember what
Yeah,
that was? Do you
so
remember what they guided for?
yes, so at the end of Q1, they guided for 3 million and then anywhere between 1 to 2% in monthly churn following that. And when you have that mapped out, it brings you to a 2026 final member count of 2.618 million members, assuming a 1 to 2% monthly churn. When you change those numbers to what we ended Q1 2026 with, that now boosts the end of 2026 number to 2.77 million, plugging in a 1.5% drop on a monthly basis, churn-wise. And what he did mention in one interview is that this now puts he didn't say this specifically, but this now brings us to a estimated 3 million at the end of Q2. Um, and now with that being said, we're gonna have more members. Um, sorry, I lost my train of thought. We're gonna have more members by the end of Q2, but we're having the members that we expected to have at the end of Q1 at the end of Q2. Um, and this was after a massive retention of 3.174 at the end of Q1, which is going to leave us considerably higher than what we initially expected, which is a very, very strong sign to see. And one thing that I mentioned that I kind of personally believe like this was going to happen was Oscar has around 90 to 95% of their members coming through brokers. Other companies, I pulled a slideshow from the CMS, have 40 to 45% of their members coming in from broker portals. And what is the significance of this? When you have all of these members coming through brokers and broker portals, they're one being verified, their payment methods are being verified, and most importantly, their subsidies are being verified. There's a lot of subsidy fraud, and if people put in their information themselves, there's a good chance that they might skew the number a little bit higher, skew it a little bit higher. The call is starting. Oh, the call is starting, Ronnie.
Okay.
Measures. A reconciliation of these measures to the
Dude, I'm
most
ready. I
directly
got that
comparable
thing.
GAAP measures can be found in the first quarter earnings press release, available on the company's investor relations
AC, can you
website
hear it?
at ir.hioscar.com. We have not provided a quantitative reconciliation of estimated full year
Can you
2026
hear it, AC?
adjusted EBITDA as described on this call to GAAP net income because Oscar is unable, without making unreasonable efforts, to calculate certain reconciling items with confidence. With that, I will turn the call over to our CEO, Mark Bertolini.
Good morning. Thank you, Chris, and thank you all for joining us. Today, Oscar Health announced strong first quarter 2026 results with year-over-year improvement across all core metrics. Oscar reported revenue of $4.6 billion, an increase of 53% year-over-year. Our SG&A ratio improved 60 basis points year-over-year to 15.2%, driven by disciplined expense management, top-line growth, and the growing impact of AI across our operations and member services. MLR improved 490 basis points year-over-year to 70.5%, with utilization largely in line with expectations. We delivered $704 million in earnings from operations, an increase of nearly 2.5 times over the same period last year. Oscar is the largest carrier fully dedicated to the individual market. Our tech-first approach, ability to efficiently scale the business, and deliver measurable value to our members positions us for continued expansion. We are reaffirming our full-year guidance and remain on track to deliver meaningful profitability in 2026. Before diving into our business highlights, I will share our early view on trends in the individual market. The individual market is resilient at 23 million lives and is a fundamental pillar of American healthcare. Consumers now expect to shop for coverage like they do for everyday products, comparing options, prices, and value. The individual market has the opportunity to deliver that level of choice and transparency. We are working with federal and state policymakers to advance policies that strengthen transparency while increasing product choice and innovation with consistent quality across plans. While early in the year, initial reports show market dynamics are in line to favorable to our expectations, Wakely's new report shows market contraction is tracking in line to favorable to our 20 to 30% estimate. We took a cautious approach to risk adjustment in the first quarter. Our reserves are built on market morbidity assumptions consistent with our pricing. We look forward to further clarity with the first 2026 Wakely report in Q2. The healthcare landscape is undergoing a major structural shift. The small group market is contracting, and consumers are rejecting the legacy model. Oscar is shaping the individual market to meet the needs of the modern workforce, including entrepreneurs, gig workers, part-time employees, and early retirees. Now I will review our business highlights. Oscar ended the first quarter with 3.2 million members, an increase of 56% year over year. Our innovative and affordable plan designs and superior member experience are fueling strong growth and retention. Our record membership underscores the strength of Oscar's strategic plan and positions us for sustained growth and meaningful profitability. Oscar is rapidly evolving our technology and deploying AI use cases at ever-increasing speed to drive growth, lower costs, and help members make smart choices. We recently launched several new transparency tools, including a real-time drug pricing feature that predicts when costs may cause a member to abandon a prescription. The tool instantly cross-references deductible status, local supply, and pricing, and guides members to lower-cost pharmacies or equally efficacious alternatives in the network. We are also scaling new bilingual voice agents to support care navigation and improve speed to care. ICHRA is gaining traction as employees demand choice and flexibility, and employers seek predictable healthcare costs. Oscar recently brought the industry together to launch ICHRA-X to meet the rising demand. ICHRA-X will be a plug-and-play data exchange connecting carriers, benefit brokers, and ICHRA platforms to create a more consistent employee experience. States like Mississippi and Illinois are taking steps to incentivize ICHRA adoption by giving tax credits to businesses. Oscar is now working with other state legislatures and business groups to advance similar ICHRA policies that support local economies and reduce the friction of traditional employer coverage. Building on this momentum, we recently launched the Lucy Health Marketplace. Lucy is a carrier-agnostic shopping platform for consumers, brokers, and employers built on one of 11 CMS-approved systems. Lucy brings together a wide selection of ACA plans with leading ancillary and supplemental products, like Aflac. We are combining our technology capabilities with individual networks in nearly every zip code nationwide. This broad coverage network allows consumers and brokers to shop, bundle, and build their own personalized coverage in a few clicks. We will continue to add more AI solutions and health services on the Lucy platform to bring more people into the individual market. Lucy represents a key step in our long-term strategy to build a consumer-driven healthcare market. In summary, Oscar Health is off to a strong start in 2026. Our innovative technology products, focused on user experience and disciplined execution, are delivering clear results. No one understands the individual market better than us. Our strong results in the first quarter are ahead of plan, and we are well positioned to meet or exceed our current guidance. We expect to significantly expand margins and achieve meaningful profitability in 2026. Oscar is unlocking even greater possibilities in the individual market. The entire U.S. economy has modernized except healthcare. It is the only major market where consumers are stripped of their purchasing power and have zero visibility into cost or quality. Our team is arming consumers with technology that puts them in control. Today, it's about choosing the medical coverage that fits your needs. Tomorrow, it's about making all of healthcare shoppable. Oscar is shaping the new consumer health economy to lower costs and make healthcare work like every modern market. Thank you to the Oscar team for making our vision of consumer-driven healthcare a reality. I look forward to sharing more details on our long-term strategic plan at Oscar Health's Investor Day on September 16. I will now turn the call over to Scott. Scott?
Thank you, Mark, and good morning, everyone. This morning, we reported strong first quarter results and reaffirmed our full year 2026 outlook. Net income in the first quarter was approximately $679 million, or $2.07 per diluted share, the highest in the company's history. Our first quarter results position us well to meet or exceed our current full year 2026 guidance. Let me now turn to details on the first quarter performance. We ended the quarter with approximately 3.2 million members, a 56% increase year-over-year. Membership growth was driven by above-market growth during open enrollment and solid retention. We started the second quarter with approximately 3 million paid members, in line with our expectations. Payment rates are consistent year-over-year and modestly favorable to our plan, despite the sunset of the enhanced premium tax credits. Looking ahead, we continue to expect gradual churn throughout the balance of the year, consistent with pre-ARPA levels. Total revenue increased 53% year-over-year to $4.6 billion in the first quarter, driven by higher membership and rate increases, partially offset by a higher risk adjustment payable accrual. The first quarter medical loss ratio was 70.5%, a 490 basis point improvement year-over-year. The significant improvement was primarily driven by our disciplined pricing strategy, claims and risk adjustment seasonality from new member and metal mix, and favorable prior period reserve development. The first quarter MLR was impacted by $68 million of favorable development, primarily related to claims run out from the prior year. That compares to $31 million of unfavorable development in the prior year period. Overall, utilization is largely in line with the morbidity of our book. I want to spend a moment on risk adjustment. Medical claims were seasonally low in the first quarter, and as a result, we recorded a higher risk adjustment accrual. It is early in the year, but we are encouraged by the data we are seeing on overall market contraction and market morbidity. Our claims experience, coupled with third-party data on both new and renewing members, points to market morbidity tracking in line to favorable to our pricing expectations. We continue to expect risk adjustment as a percentage of direct premiums to be approximately 20% in 2026 as new members engage with their benefits and members meet their annual deductibles. Switching to administrative costs, the first quarter SG&A expense ratio of 15.2% is the lowest in the company's history. The approximately 60 basis point year-over-year improvement was driven by fixed cost leverage and disciplined expense management, including an increasing impact from technology and AI initiatives, partially offset by higher risk adjustment as a percentage of premium. Across all of our key performance metrics, we are seeing significant year-over-year improvement. We reported earnings from operations of $704 million in the first quarter, a $407 million year-over-year improvement. Operating margin was 15.2%, a 540 basis point increase year-over-year. Net income was approximately $679 million, a $404 million increase year-over-year. Adjusted EBITDA was $727 million in the quarter, an increase of approximately $398 million year-over-year. Turning to the balance sheet, our capital position remains very strong. We ended the first quarter with approximately $8.1 billion of cash and investments, including $279 million of cash and investments at the parent. As of March 31st, 2026, our insurance subsidiaries had approximately $1.7 billion of capital in surplus, including $809 million of excess capital, which was driven by our strong operating performance. Based on first quarter results, we are reaffirming all of our full year guidance metrics. Total revenues are still expected to be in the range of $18.7 billion to $19 billion in 2026. MLR remains in the range of 82.4% to 83.4%, with MLR lowest in the first quarter and highest in the fourth quarter. On administrative expenses, our SG&A expense ratio guidance is unchanged at 15.8% to 16.3%. Earnings from operations are still expected to be in the range of $250 to $450 million. As a reminder, we expect adjusted EBITDA to be roughly $115 million higher than earnings from operations. In closing, we're off to a strong start to the year with first quarter results that exceeded our expectations. Record membership and strong financial performance reflect the actions we took last year to position the business for growth and meaningful profitability. We're well positioned to meet or exceed our full year guidance. With that, I will turn the call over to the operator for the Q&A portion of our call.
At this time, I would like to remind everyone, in order to ask a question, press star, then the number 1 on your telephone keypad. And your first question comes from the line of Jessica Tassan. Please go ahead.
Hi, guys. Thanks very much for taking the question. I guess my first one is just, can you describe the first quarter behavior of the 200,000 or so members who fell off between 1Q and April 1st? I'm curious if they were pulling utilization forward into the grace period or if they just kind of didn't utilize. Were they not aware they had coverage? And then can you just describe the accounting for any expenses incurred by that population in your first quarter results? Thank you.
Good morning, Jess. So I would say that for members who churned off, nothing unusual about any of the utilization patterns that we experienced in the first quarter. And those members, in general, the biggest portion of the drop-off, really are people that never made a payment. And so, we would not expect to see a significant amount of utilization for people that aren't using. And, once that person if a member goes into a delinquent status, we no longer pay claims, that you have to pay in advance in order to be covered. And so once you go into delinquency, we wouldn't expect to cover any claims that might be incurred. So really, pulling up on that, everything that we saw in terms of member transition, going from 3.4 to 3.2, and then starting the second quarter with 3 million members proceeded exactly as we expected.
Got it. So just to clarify, for that population, you'd only reflect January expenses in the 1Q MLR. And then just my follow-up is, do you all agree with the weekly assessment that market morbidity is up 2.9 to 6.5% in 2026? And then can you just describe where you think maybe Oscar's membership morbidity is trending year over year or in 26? Thank you.
Yeah. So on Wakely, look, I think it's a positive development that this new report is out. What that report is really trying to do is to take early information and look at the morbidity of who was retained in the marketplace, who were the new members that came in, and what might the risk scores look like for the people who left. And so that's the process that Wakely used to come to build that. I would say that, it's very early in the year to draw conclusions about market morbidity, but we really are encouraged about the data that we saw in that report. I would describe it as in line to favorable with our expectations. And when I look at our claims experience, kind of what we're seeing through that report and other reports, really does point to market morbidity that could be a tailwind for us this year. I would say that when I look at the risk adjustment accruals and other accruals that we booked, we have yet to take into account any of the potential favorability that we're seeing in some of these reports, and we build our accruals based on our pricing expectations. So we may have some tailwinds there as well.
Your next question comes from the line of John Ransom with Raymond James. Please go ahead.
Hey, good morning, everybody. Just want to ask a question about SG&A. So your revenue was suppressed by almost 400 basis points by your risk adjustment versus the 20% guide, but your G&A was 15.2. Why would G&A go up if presumably you're going to get a revenue lift for the rest of the year with a lower risk adjustment hit to revenue?
Good morning, and I appreciate the question. Look, I think that we saw obviously strong revenue growing at 53% based on the headline numbers, higher than that, as you said, if you normalize for the risk adjustment. SG&A grew at 46% in terms of SG&A dollars. So we are clearly seeing leverage coming through. I would say the first quarter SG&A ratio is likely to be the lowest for us during the course of the year. There's a little bit of just a dynamic as we grow membership and have some open positions at the beginning of the year. There's a natural kind of flow as we normalize the business for the higher membership. So we'll see that kind of growth throughout the quarter. I would think that from here, we'll probably see membership or SG&A ratio moving sideways to slightly up. And the fourth quarter tends to be a little bit higher as we start to pick up expenses associated with OE efforts. So I continue to think that there's a lot of opportunity to continue to drive performance and improvements in SG&A, even at the low levels that we achieved in Q1.
And I would add, John, that taxes and fees are pretty much fixed for us based on the level of membership. It's 9 to 10%. So we're looking at the variable piece that we can manage versus that fixed piece, which we literally is the tax for being in the game.
And just my second question, your old guide, I think you hinted at this, but just to nail you down, the membership in 2Q, I think you talked about 3 million. Is that still a good number to start with in April?
And then that's what we started in. That was our number, April 1.
3 million. Okay, thank you.
Yep.
Your next question comes from the line of Andrew Mok with Barclays. Please go ahead.
Hi, good morning. The risk adjustment transfer as a percentage of premium is tracking around 24%, but you continue to expect the full year to be 20%. Can you help us understand what's driving that higher now and why you're expecting that to moderate throughout the year?
Yep. So medical claims were in the first quarter seasonally low and were also favorable to our expectations. Given those low level of claims, we have a natural offset, which is when your claims content is suppressed, then your risk adjustment ends up being higher. So it's a little bit of a trade-off there. We do have a higher portion of new members in bronze plans this year. That's driving some of the seasonality that we're seeing in claims. We expect that we'll get to that 20% during the course of the year as those new members and use their benefits, and as members with higher deductible plans like in bronze start to hit those deductibles. So over the course of the year, I would expect claims to normalize, and that's how we'll see the company get to the 20% that we are projecting for risk adjustment.
Got it. Maybe just a follow-up to that point, like given the combination of higher bronze mix and silver buy downs, what are you experiencing with the bronze mix behavior at this point, and how does that compare to historical behavior? Thanks.
Look, I think that as we've said, the metal mix, we try to make sure that all of our metals have, targeted profitability and that we're not, having one perform at a really high level and others that, are drags for us. So at this point, and, we're talking about 15% of claims that have come.
15.4, exactly.
15.4, Mark always reminds me. We're early days, but everything we're seeing, whether it's through utilization, authorizations, actual claims, suggests that the risk of the membership that we have is in line to favorable with what we would have expected. And we're not seeing any patterns that cause us to believe that there's anything here that is unexpected.
Your next question comes from the line of Scott Fidel with Goldman Sachs. Please go ahead.
Hi, this is Sam on for Scott. We were just wondering, what are the key swing factors remaining that could materially shift your view on 2026 EBITDA in the second quarter and then going into the second half of 26? Thank you.
It's largely the weekly numbers and risk adjustment. And given, if you look at the year-over-year differences between our risk adjustment at this point last year, which was 11%, Scott, and we're now at 24.5%, we've begun to accommodate for what we believe to be the risk associated with morbidity, and we put that into our numbers and still generated these returns. And so from our point of view, that's the number that we wait for. And obviously, claims will develop more fully by the end of the second quarter. We'll have a pretty good pinpoint spot on it.
Your next question comes from the line of Jonathan Young with UBS. Please go ahead.
Thanks for taking a question. Just going back to the risk adjustment again. I guess, would you say the risk adjustment was just more a function of the claims data that you're kind of seeing so far? And just to be sure, there's no sweep or cleanup related to 2025 accruals within that. And then I guess alongside that, did the weekly data influence how you came to the 24% about? Thanks.
Yeah. So maybe take those two things separately. So the 24% risk adjustment level is explicitly being, driven by our claims experience. As I mentioned, our risk adjustment reserves are still based on the market morbidity assumptions that we went into pricing with and that we set our guidance with. And so we have not made any adjustments for some of the favorability that we see in the weekly market morbidity report. So again, that could be a tailwind to us, but we're waiting to see more signals before we lean into that. And on PPD, we did see some, in the last weekly report that we got for 2025, we did see a couple states that had adverse development there that totaled up to about 85 million. So we reflected that in the quarter. We did have some other states that had some positive developments. We chose not to recognize those and wait for the final report. So, we feel like we balanced the risk in that department. We also had favorable claims run out to a pretty significant degree of $150 million. So net, our PPD was favorable, 68 million in the quarter. And, when I look at the combination of those factors, I'm always happy to have, favorable prior period development. It's a gift in the quarter. But I think there's also, kind of a longer tailwind that comes with that because we did use those kind of risk levels and reserve levels in building our pricing for 26. So those tailwinds, we think will transition beneficially over the year.
And one note I make, Jonathan, on that is that the weekly report we received doesn't include experience. It really just includes some of the same demographics and things we've looked at in prior years on our own basis. So it was nice to have some outside verification of the way we view the marketplace from a morbidity standpoint. So it's not really all that tight the way we would see in a regular report on claims. It doesn't include claims.
Okay, great. And then I guess to any emerging utilization, well, actually, let me go back to the first quarter. Did flu or weather play any factor into kind of the beat? And was there any emerging trends that you're just kind of keeping an eye on at this point? Thanks.
I mean, flu was sort of okay. We had a worse flu quarter than we had in the fourth quarter. I haven't talked about flu in a first quarter call in like a decade. But flu was okay. The weather was fine. We didn't see anything abnormal in our results. And we've looked at claim submissions and lags and the whole routine with our team. And, the experience has been better than we anticipated, but we have not booked all of that.
Jonathan, I just to add to pile on there, I think the most insightful thing about utilization patterns is the lack of interest in utilization patterns.
Your next question comes from the line of Michael Ha with Baird. Please go ahead.
Good morning. This is Olivia Miles on for Michael Ha. Thank you for taking the question. Do you expect that the outlook on risk adjustment provided in the upcoming June weekly report should likely remain stable through the rest of the year? Or are there any other puts and takes, particularly with the increased members in bronze plans, that could cause industry-wide volatility in risk adjustment in the second half to materialize differently than in historical years?
I think that we sit here at this point in the year with more data than what we've had in any of the preceding years. I think the new weekly report is certainly, as Mark talked about, it gives you some level of information. Obviously, we'll all wait to see how claims performance actually develops. That'll be the most important factor that will ultimately tell us what's going on with market morbidity. When we look at all of the metrics that we have at this early point in the year, and we calibrate those against external data points, I'm pleased with where we are versus market morbidity. I think almost all the signals are pointing towards favorable market morbidity development versus where we entered the year. we'll have to wait and see there. And as we all know, each sequential report that you get from Wakely improves your confidence and visibility into where the full year is going to settle. We think Q2 will be an important first report because it'll be really the first time we'll see from a claims perspective what is market morbidity looking like. But again, we see primarily favorable signals when we think about market morbidity.
Great, thank you. And congratulations on the recent announcement of the Lucy Health Marketplace. Looking to dive a little bit more into the financial impact of this model, both in 2026 and in future years. Can you please provide some details on if revenue or an EBIT contribution from Lucy is contemplated in 2026 guide, how you're expecting to grow and scale this platform over the next few years, and any visibility into the revenue basis or long-term targets for this new product? Thank you.
So, Olivia, we'll go into great depth as much as we can in September, but I'll give you some sort of the headlines. As we talk to employers around the country, including increasingly larger employers who are interested in ICHRA as a solution, what we have found is that they're very concerned about the network. Now, while an individual buying, and this is why we've invited all of our competitors to the platform, when an individual is buying, they want to select their network. Given we're not in every market, nor are our competitors, it's an opportunity for us to share each other's networks by allowing the employer to select from different plans. Why does that matter? Because you're converting a whole employer. Now, to the economics of it all. In converting to an all-over employer, you're going to have to meet other benefit solutions. So we have companies like Allstate Health on our platform, and Aflac and Guardian, others joining us so that they can provide other tools which, by the way, they have been providing to ACA members who have had money that they wanted to buy, catastrophic illness policies or whatever, critical illness policies. But the more important part is, and this is where the economics matter, and we'll dimension this more in September, is that the margin from a dollar standpoint is higher than any insured member would bring us inside the ACA for all the employees. And it's unregulated from the standpoint of having to put up any risk capital. And it's another margin opportunity for us to grow the bottom line and the top line of the organization over time. And so we're excited about that model. We're just putting it all together, but having everybody on the platform so that we can share each other's networks. Our response to employers, large employers, is when they say, well, we have a big PPO, our response is, we have the biggest PPO at narrow network rates. So you ought to be going to us because you can't get the rates we get when you put all of our combined purchasing power together.
I'd just add that any of the cost revenues of standing up that business are included in our guidance. For this year, we would expect that to be a modest effect. But as Mark talked about, we're excited about the prospects of building a fast-growing, high-margin business.
Your next question comes from the line of Raj Kumar with Stephens. Please go ahead.
Hi, good morning. Maybe just on effectuated enrollment, maybe any kind of market level color, if any markets are doing better than worse kind of than your internal expectations, or even kind of the Wakely expectations?
Looking at the landscape of our competitors who've reported our own performance results, I would say that effectuation rates have been pretty much as expected to modestly favorable. I think that they also line up in the same way against what Wakely had assumed. So, to me, what we've seen so far through this year has been that whether it's Oscar or competitors, our expectations of how members would, ultimately roll out of the ACA have been pretty much spot on. So, again, I think that that is a positive sign. If we're seeing stability in our ability to estimate what's happening in the market, that generally portends well for the rest of the year.
Got it. And then as I think about kind of this year and some of the market dynamics, large competitor exit this year, maybe just kind of any color on those dynamics in terms of that membership and how that's trending from an RA standpoint. And then as we think about maybe 27, there's another competitor with modest portfolio of members exiting the market. So how does that kind of kind of bake into your expectations as you go into the pricing cycle for next year?
I'd like to explain that by the distribution model, because I think it's hard for us to know exactly where all our members came from, but we did pick up some auto-assigned members from a large competitor that left the marketplace. But what we did, and I'll remind you, when we did our investor day 2 years ago, we said we assumed that there'd never be any enhanced subsidy extension. That's how we built our plan. And we started building our response to that. And that allowed us to prepare products that would ameliorate the cost increase to our members. And we built tools that allow brokers to start setting aside what they needed to do for their members to retain them. Because for the broker community, it's about maximizing capacity and their ability to sell and retain. And so we gave them these products, and we gave them lists of our members and said, here are the people that are most affected, and here are the product recommendations that we would offer. What happened is that a lot of our competitors got stuck in the middle between whether or not there were going to be enhanced subsidies or not. They didn't necessarily make the plays that we made on product. And when the brokers couldn't see those opportunities, they turned around and they brought those members to us from our competitors because we gave them a solution. It allowed them to be very productive. And when you look at our growth curve, which you obviously don't see, but we see every day on our enrollment, it was almost a straight line up over the first 3-4 weeks when enrollment opened, because our brokers were ready, had already talked to their clients using some of our technology, and were able to get them signed up and moving forward.
Your next question comes from the line of Craig Jones with Bank of America. Please go ahead.
Great, thank you. So I think your member mix, when you think about like the bronze members, I think it went from a little below average in 2025 to now a little above average in 2026 versus the market. So with that mix shift towards bronze versus average, how does that impact your risk adjustment payable year over year? Thank you.
Yeah. So, our book is, we've got the bronze is our largest category, silver is a close second, gold's, a follower, but also a significant portion of the book. So a relatively balanced book. I think when you look at risk adjustment, the entire way that risk adjustment is like the risk adjustment formula actually is intending to make it neutral across metal levels. So there are some coefficients that sit in that formula that basically say the claims that you're getting and the condition value for a bronze plan, you get a bit more risk score offset, because in that plan you're getting lower premiums, and so you're expecting lower claims, and so when you do have claims, you get a bit higher risk score benefit from those claims. The inverse is true for metals that have higher amounts of benefits built into them. So in general, I would say risk adjustment really isn't driven entirely by metal mix, but what's important is for us, it is the number one, the products that we build, we tend to attract healthier members. It's the markets we're in. We tend to be in more urban areas versus rural, so those tend to skew, healthier on average. I do think that you see healthier members in bronze than in silver, for example. And, we think that across all those metals, we have an opportunity to see strong margin performance, and, would expect that risk adjustment is more driven by overall levels of utilization across all of those than any one metal in particular.
And I would add that, even given our prior period development in this quarter, what we see in our population we cover is that we've been at or below expectations relative to utilization costs. So if you go to last year, were it not for that risk adjustment change, we would have hit our numbers. But because of the change in the morbidity in the market, we have that offset to revenue, which drives up the MLR. So the MLR was driven up by the change in the market morbidity, not by our underlying utilization. And we're seeing that same trend in the first quarter of this year.
Got it. Thank you.
Your next question comes from the line of Justin Lake with Wolfe Research. Please go ahead.
Morning. This is Dylan on for Justin. Quick question about growth in historically smaller states like Arizona, North Carolina, and New Jersey. Just curious on the trends you're seeing there and any early reads on economics in those states. Thank you very much.
Too early, not enough claims, quite frankly, to have any real big differentiation.
And I just add on membership side, we're excited about the growth that we've seen in some of these smaller and newer markets for us. We have a playbook where we kind of go into new markets, make sure that we understand the local environment in a really grounded way before we really start to look for growth at an accelerated level. And we're seeing primarily strong results in those new markets, but as Mark said, it's still early in the year, so it's too early for us to get ahead of ourselves.
There are no further questions at this time. Ladies and gentlemen, that concludes today's call. Thank you all for joining.
Wow, let's go. That was great. Stock is same, 10%. Like I said, I think it's gonna be really hard to break through 20, at least until markets open and more people are able to buy and stuff. Overall, great earnings. I give it an A plus. Some people would sit there and say, "Why an A plus, Ronnie?" They missed revenue. We talked about that earlier. They're guiding for they guided to almost double their revenue year over year. So am I really that worried about a revenue miss when I care more about them getting to net income profitable this year, for them getting to EPS positive for the entire year? That's what I really care about. More revenue, more revenue. It doesn't matter if you can't make money off of it. If you keep bringing more money into your household, but then you can't pay your bills still, and you don't have any money to put in your savings or any money to invest, you're just making more money just to make it. So I want to see these things, right? The MLR coming down, medical loss ratio coming down, SG&A coming down. They did say that's gonna be the lowest for the year, and it's gonna chop sideways or rise. Earnings from operations were obviously killer. Net income was killer. Individual and small groups that decreased less quarter over quarter than expected, and year over year it's still up massive. AC, what do you think about the call?
I think it was great. I took about, if you translated this to a Word doc, I probably took around 2 to 3 pages of notes. I thought there were some very good points that were mentioned. First, based on their weekly reports, based on the overall market, there's more favorability in terms of, they had mentioned earlier on the call that there was more favorability in terms of market churn compared to what was initially expected. It was expected to be quite significant, which is still a significant number from a market perspective, but less significant. They're also continuously working on deploying AI at a strong pace. That was another big thing. Something they added was also new, to my understanding, is that they have real-time drug price forecasting, which estimates essentially, hey, when are these going to be unaffordable, which can help understand, that's going to help members understand, but also on an operational side, they're going to be able to see like, hey, when is this plan starting to not make sense for somebody? They also had mentioned that they're now implementing bilingual voice agents. That's going to go alongside of Bueno Salud, I believe it's called, where they are working alongside improving the Latino American community and the Spanish speakers out there, which is essential, very essential in Florida, because that is one of their largest markets. I mean, every time I go to Florida, I hear Spanish all the time. Like it's a very well spoken language down there in Florida. So that is a huge for their Florida markets. One thing that I'm also interested on, and I don't know if you picked up on this, Ronnie, but they had mentioned that
Did you just spit
they're
Spanish at
working.
me?
No.
You said interested.
Oh, I don't know if you picked up on this, Ronnie, but they had mentioned that there is something they're working on called ICRA X, which is a plug and play exchange process for employers and employees. Now I'm going to
Mhm.
have to go back in the transcript because I didn't fully go into that, but I think that's going to be something that's very huge for implementing ICRA in terms of, employers for employers and employees. So that's going to be something that's going to be interesting. Another thing that they mentioned uh, very early on is the addition of or working with a lot more state level representatives to kind of implement ICRA favorable legislation, specifically Illinois and another state. I didn't pick up on the other state. It might have been Montana, but they were adding employer tax credits for ICRA specifically. So that would be a very strong place to improve and really a major beneficiary for Lucy or that ICRA X. I'm very interested in the ICRA X. And one thing that they had covered previously when they announced Lucy, but Lucy's in every zip code, broad networks, adding more AI, which essentially, because they're in every zip code and they offer all of these plans, essentially this creates them to have the largest PPO because they have every network essentially. And the PPO stands for Preferred Provider Organization, um, which essentially is going to basically be your, preferred providers. And this is where my knowledge gets a little thin. But with the preferred providers, you know, you have, let's say, you always go to X hospital, but Oscar doesn't have X hospital. On Lucy, you could say, I want to go to this hospital, even though Oscar doesn't have it. Well, Oscar can still capitalize on that because they're making a per member per month um, fee on that. Uh, Also, they mentioned this, I want to say like 7 times, well positioned to exceed current guidance. I will say I don't think he has ever said this on another Oscar earnings call. You know, in all of the Q1 earnings that I've seen, I don't think he has mentioned that as explicitly as of this time. He is between Mark and Scott. They mentioned it quite a few times. Essentially, that they're well positioned to meet or exceed full year guidance. And I wouldn't put a huge emphasis on revenue, but from a profitability standpoint, hitting 3% margins, for example, I don't think that's out of the picture, especially with midpoint of guidance being around 1.9. So I do think that's going to end up being a beat. They also did mention that they had a favorable prior period reserve development. Um, Um, uh, they had mentioned, I grabbed this from the actual PDF, but the quote is the company has 68 million of the company had 68 million of favorable development in the first quarter of 2026 compared to 31 million of unfavorable development in the first quarter of 2025. And when it does come to that, that's going to affect the net revenue that is actually net revenue and MLR, because that impacts the risk adjustment, which also goes into the fact of risk adjustment is still expected to be at 20% on a full year basis. And they are essentially calculating this more so off of claims and why claims were so low and expecting this to normalize throughout the year because they don't want to make the same mistake they did in 2025 is kind of the gist that I got. Now,
And same
another
and
thing,
same mistake is, it was something that caught the entire health insurance sector off guard, with medical loss ratios exceeding like they did. So, like you're saying, being more conservative with the numbers now and making sure that doesn't happen again when that was like a one and like from history we've seen that kind of medical loss ratio happens like once in a blue moon once in a while, right? It's not the status quo. So by them being more conservative, and then him saying that multiple times on the call, like, we think we're going to exceed these meaningfully. We think we're going to exceed these meaningfully. Basically we're going to crush these numbers. Like, these are sandbag numbers. We're going to crush them. Yeah, you take that plus the fact that we just came, and this is what we talked about like all year. Last year was a really tough year. The comps for last year are going to be amazing. They're going to be amazing for us this year as shareholders. And then another thing I wanted to bring up, look at this example. Look at this banner that I had from the last time we did earnings. I was talking to you about earlier.
Yep.
So 3.4 million, I made this during last earnings call. 3.4 million members will most likely churn down to 3 million by end of first quarter. Well, no, they beat it. They crushed it, right? They retained 174,489 more members. That is a really good start, and probably not a lot of people are going to be talking about that, because you have to actually remember, like, oh yeah, like last quarter they did 3.4 million members and there was like this big shock, but they said it was going to churn down a lot, but then it didn't churn down as much as it was going to. So there's a possibility by the second quarter, right? We could still be above 3 million. If we're still above 3 million members, I don't know, man. That's really, really bullish. And that means that they're not getting as much churn and as they expected, right?
For sure, yeah.
Yeah,
I did.
besides that, in case nobody knew, right? Because we might have some new viewers here before we get more in like detail about the numbers. Someone might be sitting there saying, okay, I just hopped on this stream, Oscar Health. What is it? What do they do? And why should I be bullish? Well, in the simplest form, they are a health insurance company that is trying to put an AI spin. Now, I know the AI word gets thrown around a lot, but they're a health insurance company that is trying to put a spin on the entire sector. This health insurance sector is overly ran by legacy health insurance companies that haven't consistently innovated because they haven't had to. They haven't been pushed by competition to consistently innovate. And that's where Oscar's coming in. And they're led by Mark Bertolini, their CEO. They're led by a guy who took multiple health insurance companies from basically like Aetna Group, took them from a small guy to a large guy, and then got them sold and acquired to CVS for a very, very handsome amount of money. Retired, came out of retirement to help with Oscar Health and basically change the health insurance industry. He has been very nitpicky on the entire health insurance industry for a good reason. It's very broken in the United States. And basically his whole goal is to change it for the better, so people like him at one point get the care they deserve for the right price and get cut out all this political BS, right? Because if you just go listen to the guy's story, his kid's story, it's truly remarkable what this man has been through, and he's still, just grinding away and trying to do good for the health insurance industry. The health insurance industry that, by the way, has been very, very scrutinized and looked at as fat money, just doing terrible things, blah, blah, blah. Just look at UNH and the whole saga of CEOs and blah, 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 right? But anyways, AI spin on health insurance to bring a new look to it. But honestly, and AC will probably agree with me, the thing I'm most excited about is they are doing what he's been talking about. They're creating a one marketplace for all. And this is like truly, in my opinion, like out of left field and could be massive, guys. Think of it like this. Health insurance, everybody's buying health insurance through brokers, and they're buying health insurance. Like brokers have their brokers have their companies and their health insurance companies that they like to pitch, and they like to be, they get commissions and all this different stuff, right? So it's like you go to a broker and you're like, hey, me and my family need health insurance. Well, okay, so we can go with this cheap option, or we can go with this option. You get more coverage, blah, blah, blah. Well, some brokers might point you in this direction more. They might point you in that direction more. And overall, when you come, it's not really, like Mark says, it's not really like a free and fair market. It's more so like whoever you know and whoever is covering your area. And like, you don't really get to shop much. Like when we just renewed our health insurance for my family, we had like two options. Like what Mark and Oscar are trying to do is they're trying to create, and they are creating, this marketplace to where you can get health insurance, what you need, and at the price you feel like you should pay, right? It's just a very competitive market. It's just a game changer. I don't know if you want to touch on it at all, like your thoughts on it, but I thought it was like something like, I was like, wow, like that's out of left field. And I was already super bullish on the company, and now it's like I'm even more bullish.
I think too, when it comes to this earnings and, what they're doing, I think it was very clear that they were going to crush it from a while back. And, when I had my predictions, or like what I was thinking was going to happen, I said 10% operating margins, beat on everything. And, for the most part, I was correct. The only thing that really the only thing that impacted those from being correct was that the huge beat on operating margins offset my revenue expectations because of risk adjustment risk negative risk adjustment positively translated to MLR. Um, so I definitely do think that it was a very strong earnings, and you know it was it beat my expectations in a strong way, even though revenue was technically missed. Um, and another thing too, with the earnings is that what they're implying based on this quarter's MLR is they're going to see elevated MLR volatility throughout the year. We look at 2024, Q1 2024 MLR was 74.2, Q2 2024 was 79, Q3 2024 was 84.6, Q4 2024 was 88.1. Now, what they're implying, if they want to, and that ended 2024 with a full year MLR of 81.7. And if they're expecting 82.4 to 83.4 for full year MLR, they're going to have to see a significant uptick between Q2 and Q4 in the MLR to make that happen. Just because we're already almost 400 basis points from, Q1 2024. So on a full year basis, seeing potentially 80% MLR based on how well they're already beating, that would, that would seriously put a positive twist on their margins, and that would almost achieve 5%. And this is on the most bullish end. This would assume no volatility. But if we saw it, closer to that 5% margins, or 4%, or even 3% margins after 2025, there's no reason that this stock should be anywhere below $35 a share. And that's kind of the thesis behind that, which is great. And
Yeah,
kind of the
with the
more
revenue they're pulling in, and the margins he's talking about getting to, it's just, even with like a 10 PE, and like a 10 PE is like, that's a health insurance industry PE. But when you factor in membership growth, revenue growth, and you factor in that this company is innovating and a disruptor, yeah, you're going to get a higher PE. So yeah, I fully agree, man. Like it's been undervalued for a long time. Last year, it was like, okay, I understand why the sell-off happened. I understand, right? Because it's like EPS went down to negative whenever it was supposed to grow to positive. Like a lot of things happened last year, but this is where you had to understand the company at a deeper level, understand that medical loss ratios was a temporary heightened thing. and it was across the sector. And we continue to say that over and over and over again. Medical loss ratios, this is not the norm. This is not how it's supposed to be. This is not the average that it is. It is highly elevated, not just for Oscar, but across the entire industry. And that's why the health insurance industry, Cigna, Oscar, UNH, they all fell massively this past year. It's because medical loss ratios were elevated. And we kept saying this, like, wow, Oscar's down here at $10, $11. I hate to be like, it's not their fault, but it's not. That's how health insurance works. Like, you can't control medical loss ratios. You can try to combat it with higher numbers, and that's what they're doing this year. And we didn't even talk about that really. They came into this year adjusting risk for last year's medical loss ratios. Now we see the first quarter medical loss ratios are very low, and they're expecting them to be low for like climbing higher, but still being low overall for the entire year. That's massive. Now, another thing, if you don't know this about health insurance companies, they can only keep so much like profits, right? So if they said we're going to charge you $20 for the entire year for health insurance, and they did like $40, they can probably only keep like $30, right? So they make $10, and then they got to refund. They got to do rebate they got to refund, do rebates, whatever, back to the insurance customer, right? Because that's in law, right? So health insurance companies don't take advantage of the small guy. But yeah, one of the questions that I wanted to answer on here was, and you already answered it, but will Oscar be acquired? If you know Mark Bertolini, that is like, I mean, I'm not going to say it's 100% no, but it's pretty close. Because if you know Mark Bertolini, he came out of retirement not to make more money, not to, try to build a legacy. He came out of retirement, and he said this over and over and over again. He came out of retirement to build something lasting in the health insurance industry and make a free and fair market. That's what he's been preaching about for a very long time, and that's what he's trying to do. So for them to sell the company or make a bag, he said this multiple times, that's not his goal. That's not the company's goal. Their goal is to help as many people as possible. And they've been talking about it for a while now. They are constantly taking on the person with diabetes. They're constantly taking on the person who has heart conditions. They're taking on people that are higher risk because they think they believe and they have standards, and they believe that that everybody deserves health care. And that's very different than a lot of other health insurance companies. A lot won't take you on, or they'll charge you just a euphoric amount of money, right? What are you seeing in the comments? Anything else we should highlight?
I was going to say too, I was going to add on to your MLR. Thought was that when they have to pay the minimums and the rebates, I'm trying to get a rough number here, but they have to. So the way that the MLR rebates are paid out is for individual and small group insurance plans, the minimum is 80%. For large group insurance companies, it's 85%. This is on a trailing 3-year basis. So I just put some numbers together, and at 81.7 MLR for full year 2024, 87.4 full year 2025, for it to be a 3-year average for them to pay rebates out, they would have to achieve a full year MLR of 70.89 or below for them to have to pay rebates this year, which means they essentially, even if they achieved 75% MLR during this year, they would not have to pay rebates and even have to worry about it until about 2020, probably 2027. But even then, you have the 2025 skew. So them having to actually pay out rebates is not really in the question probably until 2029.
That's not going to happen, because 70.5, and then it's going to continue to grow throughout the rest of the year. And they said it'll probably be closer to like 80 by end of year
82.
for the full year. So 80, like 85, I think they said. So, nice.
So
Yeah. Good detective work there. Yeah. That's massive too. I mean, because again, they are charging more this year to combat last year. But the funny thing is this year, medical loss ratios are going to be less than last year. So that's why you're seeing something like, $2.07 compared to like $1 in some sense on EPS, just a massive beat. And you could continue to see this all year. I mean, what do analysts have? Analysts have an 81-cent EPS estimate for this year.
Yeah, that's not
81 cents. That is, God, I mean, they just did $2.07. Now they're not gonna do $2. They're not gonna do $2 every quarter. They'll probably do less and less every quarter. But man, to start off at $2.07 and then to get to 81 cents, they really gotta like just keep coming down.
I have I was going to say
What's your estimate for the full year?
So full year, I didn't update my kind of model or expectations for this one. Full year, I mean, I was closer to like 2.6, 2.7 beforehand.
Yeah.
And this was only because my original expectation on a basic for EPS was 186. That's what I kind of posted on YouTube yesterday. I was like, I'm expecting EPS to be actually wait. It was around 3.8, 1.8. No, it was 1.77, I believe, was my it was around there. 1.8-ish was my initial expectation. I did post on my YouTube video, so I have a trail there, but it's around 1.8 was my EPS original expectation. So we actually beat that, and I think some people kind of thought that my EPS expectation was kind of crazy, probably at first glance, and then we got earnings, and it's like, no, you weren't bullish enough.
Yeah.
But I did have two more things to
I mean,
mention.
what did you say yours was?
1.8.
Yeah, so you were higher than the highest analyst. Out of so AC versus 7 analysts, AC wins. But you said, what did you say for your full year that you think?
I had my full year around 2.7, 2.6.
That's massive. So, two things before I let you go on your the two things you want to cover. One, you're expecting, and honestly, I think 81 cents is way out of the question now, because they would have to go negative for 2 of the last 3 quarters on EPS to like really bring down this $2. So yeah, definitely at least over $1, probably even beating this high of 115. Basically, consensus EPS, these are going to have to go up. Analysts are way off. They were way off this quarter. This is going to have to go way up. The second thing I wanted to touch on, these price targets are about to go gangbusters, guys. Gangbusters. These analysts have consistently said underweight, neutral, $15 price target, $17 price target, $18 price target is the high. Well, right now we're sitting at almost $20 in after hours. They just completely crushed their earnings. So the thing you have to know about analysts too is they're always going to chase the stock price. So if these guys are sitting there with a $15 price target and then price stabilizes around 19 to 20 bucks, they're upgrading. They're going to upgrade because they don't want to look like idiots, which they have looked like idiots for a while. But yeah, so EPS estimates are going to have to get revised. Targets are going to get revised. And then, guys, we could see a full-on just bull run on Oscar. If they just start coming in, analysts keep running the price up. I mean, that plus great earnings, plus revisions to EPS. And then now you're talking about $2 and some cents for the year. And I mean, if you're talking about that, if you go to EPS real quick, right? Even I was running the numbers at 81 cents for this year, and then growing an average of 35 cents, right? That gets you to $2.69 for year 4. So by like 2030, 2040, or sorry, 2030, 2031, this puts you around, today's price should be around 27 bucks, and then the 4-year target should be around 40. Well, AC was just saying that he thinks they're going to do $2 and he thinks they're going to do 4 years out in EPS this year instead of 81 cents. And if that comes to fruition, then yeah, his price target of $35 plus is definitely, that's probably too low still. Not to put price targets out there, not to be like, yeah, if this happens, this will happen, because right now, as we've seen with like a company like Zeta, they crushed it and they're not getting the respect. You just have to realize the environment that we're in right now. The environment that we're in right now, guys, is that everything is around AI, semiconductors, the build out of AI. So, you know what I mean? Like 140% in a year on semis, 41, 42%. I've even seen a couple comments. It's like, how are we bullish on Oscar when semis are running the biggest they've ever ran? Like, I get it, but like, you have conviction where you have conviction. And like, right now, I rather not chase semis and I rather buy more Oscar at these prices because they are accelerating. Yeah, they're accelerating very fast. And like, I mean, it's just a severely undervalued company. Same thing with like Zeta. But all right.
I was going to say too, when it comes to EPS, my expectations play in a meaningfully positive Q1, of course, a Q2 moderate, and Q3 flat, and Q4 negative. That's what I've kind of built into my expectations and my model. I do have to update everything now just because everything's changed quite significantly. I mean, we just posted 70.5 MLR, which is insane. And then for the two things that I did want to mention, first for prior period developments, there were a couple states that had negative developments of 85 million for which impact risk adjustment, and there were some states that had positive developments which they're choosing not to recognize because they don't want to recognize something until the actual report comes out. So there is a little more potential upside in the risk adjustment as well. And then actually more so two more. One small thing is they picked up auto-assigned members from another competitor who exited, which also probably fueled a little bit of their growth towards the end of the open enrollment period, I'm assuming. But also on the ACA subsidy note, they had mentioned quite specifically, and they kind of called out a few of their competitors, is that the competitors hesitated and assumed that ACA subsidies might be extended. Meanwhile, Oscar put in the work and assumed that they would not be extended because they don't want to take that risk of playing a 50-50. And because of this, when open enrollment period actually started, the growth trend was a straight line up because their brokers were actually ready compared to these other competitors. So I thought that was a very interesting thing. But another note was actually on morbidity. And the risk adjustment was higher in Q1 because they wanted to be more accurate and align with prior actuals. So they would actually be a little more conservative on that end because they saw a similar trend in morbidity in regards to risk adjustment. They wanted to showcase a similar trend from 2025. So they had risk adjustment higher in Q1 2026 because they don't want to run the same situation in 2025 where they had 11% accrual and then see a massive wipeout of all their earnings throughout the year. So they factor that in. But another question is if 2025 never happened, if 2025 never happened, would this mean that the Q1 2026 MLR would have actually been high 60s? Because if their risk adjustment wasn't accrued at 24%, and let's say they were a lot more conservative and put it at, hey, let's say 15%, kind of a similar trend to 2025, they would have posted 68% MLR. And that's kind of crazy to think about. And it's also very crazy to think about that even with 24% risk adjustment accrual, they were able to post a 70.5% MLR. Like, that's just insane. And that's very crazy to think about.
Real quick, AC. If they sell this thing back into the 18s, if this oh man, dude, if they sell Oscar back into this resistance, I am about to buy stupid amounts more of this company. It's like people don't realize like if earnings confirm everything that you've been talking about, your conviction, your bull thesis, I do believe it is okay to buy after earnings. It's kind of like sitting there and saying, okay, I really think this is going to happen, but earnings are scary because it could not happen. They can miss. They could be interpreted the wrong way. The stock price can fall. It happened with Zeta, and now maybe it will happen with Oscar. If they crush it and then they fall, but the initial reaction was like 10% up, you just got to realize that Wall Street might just want to bring down the price and then get into the stock before it starts running again. And you also have to realize, like I've been talking about, that the stock is up now 83% in like a month. 83% in a month off these lows. So a cooling off period or something, I wouldn't mind it. I would be loading up more, especially now you have earnings out of the way and you have confirmation bias, right? You have confirmation of great earnings and they're doing what they said they were going to do. They said they're going to get back to profitability in 2026. They come in and did 87% surprise on EPS. If people want to nitpick this revenue number, by God, let them. Let them. If you start debating someone in your comments, or AC, I'm talking to you too, like if someone starts talking about revenue, just be like, yeah, man, the revenue is terrible miss. You should sell your shares. Let them sell. Everybody can
Short
just
it.
sell their shares that they want to. Go ahead, crash it back
Short
down.
it.
Yeah, short it. Crash it back down to 16s. Bring it back down. Let it rest for a little bit. I don't care. Go ahead, do it. I will buy more leaps because the time to sell was before earnings, if you believe that, if it was just a trade. Now, after everything and how great they just did, if you're going to sell it now, I mean, if it's a trade, cool. But like, dude, like they just confirmed everything we were hoping for. Like, sell it off, please. Please do the same thing that you did with Zeta. I would love that.
Oh,
Because
yeah.
I would just buy more, man. Like, it's absolutely insane. Yeah, they already had the guide. Next quarter, they're saying 23 cents of EPS, 4.78 billion in revenue. Yeah. I don't know about you, man, but like honestly, I could care less about the revenue. Like the fact that they're gonna do 18 billion plus for the full year, I mean, I'm good. Like and that's the thing people didn't realize last year either. They were like, oh, the revenue missed big, and like, but they guided higher. I don't know. What do you think about I really don't. I don't want to say I don't care, but like I care more about the profitability because they're making a bunch of revenue. They're making more revenue now, a lot more. Now I just care really about the bottom line. Let's see the bottom line. Let's see that continue to grow. Let's see EPS, net income, free cash flow continue to grow. That's what really matters to me.
Based on the revenue guidance that they have given in every Q4 earnings call for the last 5 years, minus 2023, which was their 1 year that they lost members, they have beat guidance on a full year basis. So this is based off Q4 of the prior year's earnings. First off, I just want to re-highlight that.
Yeah.
So I do think on a full year basis, they're going to be in line or above. And I think their assumption on risk adjustment is smart, because what this is going to do is this is going to allow them to have margin expansion throughout the year. If the weekly reports come in positive and risk adjustment is better than expected, the Q4 earnings could be break even or just barely negative rather than notably negative. And what we've typically seen is that Q4 tends to be pretty negative, negative or break even. And, if we see, let's say we see $1 in EPS in Q2, and then in Q3, we see a slight uptick, maybe 10 cents EPS. You're at, what is that? 207 plus $1, 307 plus 10, 317 in EPS.
A
And then
dollar,
let's
they're
say,
basically forexing their what the estimates have at 23 cents.
yeah.
Oh man.
And then in Q4, if we end up seeing a negative hit, which is expected, let's say 50 cents, you know, that's still way notably above anyone's expectations. That's
Yeah.
around, what is that, 377? 277, I mean. So I just think the market's completely oblivious to what I think is coming.
Look, we
I
already got the
think,
numbers updated. My gosh, dude. It's always nicer when you have the charts and you just like see the numbers instead of like doing the calculations yourself off this, right? You can run the calculations off this, but it's just nicer when you see a nice visual, right?
oh yeah,
56% free cash flow margin for this quarter.
sheesh.
56. Look here. I'll make it easy for everybody. Check it out. Since 2023, have they ever? They've doubled like the highest. Dude, come on, man. You want to talk about net
I know it's
margin?
kind of,
Go ahead.
with that number being so high, I kind of wonder. I'll have to look at this later. I'll make a note of it. But like, I know insurance, it's kind of, some people love it, some people hate it. Looking at free cash flow,
Yeah, because you have to
just
pay. You're getting free cash flow, but you have to pay out the claims and everything like that. I still like it. I'm not.
yeah,
You shouldn't just only base your projection. And this is the mistake. I'll be humble. This is a mistake I made early on with Oscar when I looked at when I looked at a DCF model. I was like, oh my gosh, look how much like it's so undervalued. But like, it's not. I mean, like it is, but it's like if you look at a DCF, it's going to tell you that this should be like a $300 stock. Is that accurate? No. So you do have to, take that with a grain of salt. But yeah, man, like these numbers are crazy, dude. 14.6% net margins, and the highest they've ever been was last year, the same quarter. So look, 8.3 to 9 to now 14.5. And
yeah.
then for everybody that's watching, they already said it's going to decline throughout the year, right? Their net margins are going to decline throughout the year. I would say not as much as 2024 and definitely not as much as 2025 due to medical loss ratios being more stable this year. So you'd probably see like a 14.6 to a 5 or 6% margins to a -1 to 2% margins, and then, probably between -5 and -1% margins for the rest of the year. But still, that's going to get you to a very, very handsome outcome for EPS and net income for the year. Operating margins are obviously way up. Gross margins, those are basically in line. But yeah,
I'm
man.
working on updating my model currently, and I like doing everything old school on a nice Excel sheet. So,
Dude, do you remember when you first started following me on X? Did you ever see my Excel spreadsheet on
I
Oscar?
think I think I might have.
I called it the
It's been a
snapshot
while.
because I had like a DCF and EPS model on it, and it was like this big giant spreadsheet that I like built for years and years and years, and I always used. And then that's how Value Snapshot was born, because I was like, I'm so dang sick of running these and hand jamming these numbers into Excel. And you don't have to hand jam everything, but there is a lot of hand jamming still. And whenever you're
Yeah.
looking at multiple companies, and that's why, they always say the best products come from whenever you build something for yourself and to make your life easier. I literally built this platform, Value Snapshot, to make my life easier so I can just look at everything I want to look at, like market briefs, and look at the overall sectors and then run my analysis and then just have the automatic data come in. Like that's, dude, it makes my life 10 times easier. But to talk more so about what we're seeing in trends, the overall trend quarter over quarter over quarter is very, very nice. Are you seeing this, AC? 2.1 billion in revenue to 3 billion in revenue to 4.6 billion in revenue. And it's like, okay, we're getting more revenue. That's great. But we also need to get more net income. 177.37 million in net income, 275 million in net income, 679 million in net income. Imagine if this company was doing like their first quarter numbers for the entire year. It'd be we would be talking about $100 stock, wouldn't we, AC?
Yeah.
But
I definitely think it's gonna. I think it's gonna probably take like a 2-3 years maybe to get to that point. But
oh yeah, for sure, it's gonna take time.
It'll be interesting to see though. It's
You're
very
seeing
exciting.
the right trends, man. You're seeing the right trends, right? Like last year was a hiccup year. Like really, it was Q2, Q3, Q4. Q2, Q3, and Q4 from 2024 to 2025, massive fall off, right? Again, due to MLRs. So this quarter is great. I think if we see Q2 come in, look, if we see Q2 come in and beat like 56 million, let's say we do, 200 million plus in net income, I think you're really going to see people start paying attention. I think they're going to start paying attention here. But you know how it is, right? It's like first quarters have always been good for Oscar. It's like okay, like if you're looking at this company like an analyst, right? Let's be objective. First quarter is always great for Oscar. Now, if they come in this second quarter and they demolish it, they don't even have to demolish it like they did this quarter, but if they do anything like even half of what they did this quarter, that's when you're going to stand up and say, that's my company. That's my company. They are destroying it. You know what I mean? Because
Yeah, for sure.
yeah,
I
56 million to negative 228 million to then like positive 200 million. Dude, it would be massive for shareholders and for the company. It'd be a huge prove it quarter. It's very,
No.
you know what's funny, dude? Like my two biggest highest, and I'm gonna let you talk in a minute. The two biggest highest convictions I have you noticed Zeta and Oscar? They both do very well in the beginning of the year, and then throughout the rest of the year, it's more cyclical, and they like kind of like fall off a bit throughout the year. It's
a
funny.
little bit.
Yeah, it's funny.
Very. I know. I'm with you on Zeta at the moment, and it's been an interesting run for sure. They posted a very great quarter. But what I was gonna say too is I updated my spreadsheet a little bit as you were talking, and I had a 1. I had a 2 instead of a 1 on my original one.
Idiots. Oh my gosh. Yes, dude. I knew it was going to happen. Sorry to cut you off again, man. That was a live reaction. They're only up 3%. Wow, dude. Oh my gosh, dude. People are going to be like, they're going to say the same thing they said with Zeta to me. They're going to be like, oh, the company could do all the great numbers, but they can't hold above X price. They can't do this. AC, forget about how these companies have ran massively over the last month. Forget about that. Let's just focus on you're not pumping my bags right now. Dude, oh my gosh. Please sell your shares. Please go negative. Oh my gosh, dude. I'm not AC. You're hoping this thing goes negative too, right?
Right now, I would like to purchase some more shares, just because I'm not even gonna lie. On the dip, I did not have enough buying power as I wish I did. So I'm like,
dude, that's so normal, man. That was a vicious dip. It was vicious.
It was.
Because we're bullish around 18. And if you're buying at 18 and then 17 and then 16 and then 15, it goes to 11 or 10. It's very difficult to like maintain that buying power. Like, I totally understand that. Everybody should
I'm
understand
not,
that.
I'm not even gonna lie. I did let's say out of 100% buying pie, I did about 65% by the time we hit 13, and I put like that last 35% at like 12, and between 10 and 12, more so towards the 12. And I'm just
That's really
like,
good though, man. That's really good. I mean, 13s on this company. I mean,
uh,
that's really good. So, I mean,
I,
yeah, it's not going to go from 18 to 13.
yeah, I,
My,
I was
go ahead.
I was gonna say on a full year basis, I uploaded my Excel sheet while you were talking a little bit, and I have
Yeah,
$2.11 for full year EPS.
let's pull it up.
And that implies a 79% MLR and 15.5% SG&A for Q2, 84% MLR and 16.2 Q3, 89% MLR and 16.4 SG&A for Q4.
Did you upload it to X?
Oh no, I can send you a picture though.
Oh, market's open now. Oh man. All right, we're back to 10% up. You
Really?
had you had you had like a millisecond to buy it at 1781.
Oh my gosh, my P&L chart is so vicious.
Yeah,
It's
dude.
like a sharp needle down and just
Yeah.
it always amazes me. I sent you my screenshot as kind of my
Where'd you send it at?
I put on X.
Okay. Let me pull it up over here. Keep these people out my DMs.
I
Let's
have to
see.
update some minor things, but that is pretty much what I have it as right now.
All right, yeah. So you're gonna see a pop off earn or off open. So we just opened up. You're gonna see a pop off open because people put their buy orders off the open. So their buy orders are getting filled right now. I would probably assume that you're gonna get this push up, and then because of the way it was going right before market open, it probably does come back down here to like low 18s, high 17s, in my opinion. We'll see, but I would probably say that's probably what's gonna happen. And I know some people are going to be like, "Why are you rooting for your stock to go down?" I want to buy more, dude. You get confirmation bias of us doing as well as we did, and then you get to buy more after. It's like the same thing with Zeta. Like, wait for the pump to end, wait for it to pull back, and then you get to buy more at a great price. Okay. After you confirm earnings were great. Like,
Yeah.
to me, it's easy, man. It's easy. I'm pulling it up. Hold on.
Yeah. It's always crazy to wake up on these earnings days because I'm like trying to keep up with the comments I have in my section. And it's like in the mornings of earnings days, like I have so many comments and likes that I'm trying to get back to. And I didn't leave my phone this morning for like an hour and a half straight. I'm like, oh my gosh. Let me like
Here we go. There we go. All right. Talk to me, Goose.
all right, this is my little Oscar forecasting track sheet. Um I achieved the full 20% risk adjustment with this as well. I updated that, having it around 20, just about 24%. I rounded it up 0.1% for Q1. I did this on a monthly basis too, just to anticipate the churn that is kind of been anticipated of 1 to 2%. So I have a 1.5% monthly churn, which was talked about in Q4 2025. I put that at the midpoint, especially now because we've been seeing strong member retention. That's kind of my expectation. I do expect this to be on the lower end, though, just to more so towards that 1%, maybe like 1.25%. But essentially, on this is kind of where my EPS calculation comes in and what I think is going to happen. I have to update on that screenshot. I have to update the members, but I do expect full year revenue to be just over that 18.7. And that's going to be mainly fueled by the fix in risk adjustment. I'm going to have to redo my analysis on miscellaneous revenue as well, because I do believe it actually came in a bit higher in Q4s. But essentially at the bottom, you'll see my EPS calculation. And when you sum that up, it ends up coming to $2.10. And, $2.10, when you're looking at a price prediction standpoint, it's nowhere where these analysts are exactly anticipating right now. Even as Ronnie had mentioned, like Q1, some analysts were expecting as low as 0.80, some were expecting 1.10. And I made my video yesterday and I was like, we're seeing at least 1.6, 1.8, somewhere around there. And then we saw 207. So I do think it's going to be a big beat and raise situation from a profitability standpoint. I will say from a revenue standpoint, I do think we're probably going to be on the lower side of that on a full year basis, unless we get to see some more prior period positive developments. I do think the low end of the guidance is anticipating, a higher risk adjustment, about that 20% standpoint. I'll take that over the 210. Yeah. I will say, just based on seasonality, Q1 and Q2 are most likely going to be positive. Q3 is going to be break even / barely negative, and Q4 is going to be more so on the negative end. And it's just typically what we see. I did want to kind of do a quick, fun analysis, just comparing it to 2024. 2024, we had 74.2, 79, 84.6, and 88.10. Like if we even swap that Q4 number, drop that a little bit lower, we're seeing almost 4% operating margins, swapping that for 88.10, what we saw in 2024, you have 3.78%. One thing that I am kind of wondering is, if risk adjustment is expected to go down throughout the year, if we see risk adjustment steadily go down, and just for the case of this situation, I put it in as 20% in Q2, 18% in Q3, and a 17% in Q4 to get a full year 20%, just by using the spreadsheet. And what it kind of puts me in as is, when you're looking at this situation, is this is going to impact the MLR equation as well, and it's going to raise the net revenue, which is the denominator of the MLR equation, because from a high level standpoint, it's essentially medical costs over net revenue. And if that's going to skew the denominator further from the numerator, it kind of puts you in a situation as MLR just going to continue being low throughout the year. And, maybe that close to 5% margins, maybe we end up seeing somewhere closer to, 4% margins on a full year basis, because 14.3% operating margins in Q1 2026, that's going to be a major pull to the downside, which or a major pull to the upside in operating margin percentage. So I will say on a full year basis, it's going to be very interesting. Especially last year was 87.4. 86%. Oh yeah. Dude, from an EPS standpoint, absolutely murdered in Q4 or Q1 2026.
They're at 6% up, about $19 now. Dude, they continue to sell off Zeta. It's so funny, dude. Oh man.
The only thing I don't like is on Zeta, I do have some September calls, which, I mean, not September, December, or what is it? No, it is December. I mean, September.
What's your call? What's your strike?
I have a September at $25.
I think you'll be fine.
That is my lowest. That I would say that was my highest risk contract at the moment. Everything
I think
else
you'll be
is
fine.
either
I have some $25 calls for January 2027. I know I have a little bit more time, but did you see it? Did you see the comparison? I know we're talking about Oscar. Did you see the comparison of Iren and Zeta that I did?
Oh, from a technical standpoint,
Yeah.
I did see that. It does look pretty clean.
It's just funny. So Iren, right? Everybody was hooting and hollering here. And then Wall Street sold it down last week, 10%. And then the real move happened this week, 28%. So
It's crazy.
typically when you get this, it's like, okay, everybody's in. Wall Street wants in, so they drag it down to the depths. And it actually went lower than that 10%. It went down
Yeah.
like, dude, from here, it went down like 16%. So they shake everybody out and then they send it.
Oh yeah.
Look, I don't know if they're going to do the same thing with Zeta, but I've been talking to Nick. I have the strongest gut feeling that is what they're doing here. I have the
Yeah.
strongest gut feeling, man. Like, run it, earnings, drag it down, sell it off, and then next week we fucking start ripping. Excuse my language. Might be wrong, but man, like, it looks so similar. And then like you look at the indicators, and I don't know, man. It looks really good, really good. But getting back to Oscar,
One last comment on that. I was going to say Zeta right now is kind of my wheel baby. It's I basically run like a modified wheel strategy on it. So
good.
all my money's
IV's been
being
high. I was
Yeah.
telling everybody, dude. I don't know if you watched the pre-earnings or the earnings or anything. I kept telling people, stop buying calls in this thing. Do not buy calls in the earnings. The IV was so high.
Oh yeah.
And now, anybody that didn't listen, anybody that bought leaps like that the last few weeks in Zeta, anybody that bought short dated calls, they're cooked. I mean, they're probably down like 80, 90% on like short dated, and then leaps, they're probably down like 40 to 50% because that I was so high. You got to not buy when everybody's buying. Sometimes it works out, but a lot of times it doesn't. Like Oscar's IV was high too. And I've been saying the same thing. Don't be buying calls into this earnings. And this is why I also think that them being up 6% right now, dude, Wall Street plays games, man. Wall Street plays games. I wouldn't be surprised if we end up down on the day. I don't know. At some point, I'm not saying we finish down, but like, dude, I think they might do the same thing they did to Zeta because it is a small cap. They can manipulate it. And look, we're already going down. I mean, we're already sub 19 now.
Yeah.
Like, they are going to crush that IV down. Remember, a lot of Wall Street sells options. They don't buy options. The market makers are big sellers of options. Let everybody gamble on options. That's the way Wall Street is. So like what you were saying with like you selling options and doing the wheel strategy, kudos to you, man. That's great. That's really smart. When you get high IVs and stocks that you're in, that is the best time to be selling options because the premium's so juicy. I mean, it's just like insane premiums.
I was going to say, do you have an updated on your site? Do you have an updated price to sale ratio currently at the moment? I was going to say we've got to be like 0.3
Honestly,
again.
probably do because everything else came through. Let's see.
Because I don't want a forward price to sell. I think we were like 0.2 like literally.
Oh, sorry, it's going to be on the financials.
I'm looking at some other sites and they don't have them listed.
0.37.
What was that?
0.37.
0.37. Okay.
Yeah, it was 0.2, so it's updated. Also, just to touch on one last thing, and then I'm gonna probably wrap up. On Oscar. No, I don't have the earnings transcript on here yet. Anything else you wanted to touch on with Oscar?
I guess I'll just leave it off at this. They had, if you watch the Ivy interview, one of the recent interviews on Ivy, Marcus said, like, we look at the way that they kind of develop their strategy is we have a 3-year outlook, 3-year operating plan, and we assign individuals to each aspect of how we're going to achieve that operating plan. And that's exactly the execution we saw here. And it was tremendous execution. And while others were asleep at the wheel, contemplating if they were going to create more customizable plans and if the ACA subsidies would expire or not, Oscar was like, we're going to assume the worst case. So then no matter what, we end up with the best case. And that's exactly what happened here.
Yep. I agree. Oh, there we go. Now we're down. See, man, I know my technicals, dude. We're down back to 3% up, down to 1855. What did I say? I said people place their limit order. People are sitting there listening to us or whatever. They saw the earnings. They were like, oh my gosh, Zeta or Oscar beat big. They sit there and they say, okay, market order. I'm gonna buy 10,000 shares. I don't know if you're like that, but if you're like that, man, good for you. I'll buy 10,000 shares on the open. And then what happens? Off the open, stock price runs up. But pre-market, it told you, because we were already up 10%. I think 15% at one point. And then right before market open, we got all the way down to 3%. And then off the market open, we ran up because people had their buy orders. They placed them. They went to work. And now they're going to open their apps again. And then they're going to come over to X and they're going to be like, Ronnie, AZ, you guys suck. You guys can't even get this dang stock to move higher, blah, blah, blah. I'm like, okay, dude.
I was going to say too.
You're seeing Wall Street games, man. You're seeing
I
Wall
was gonna
Street
say
games. 2% up.
I was going to say I sold cover calls at 21.5 and 22 just because the IV was through the roof on some of these contracts. I was like, sweet, I'll take a free $150 for a few hundred of my shares. I was like, it
Yeah.
typically ends up being what happens, especially with these, small caps. They get manipulated until retail starts selling and then it goes crazy. I don't know if you're familiar with the like the retail trends on Robinhood, but while Oscar went on that like near 100% run from like tens to getting close to 20,
Yeah.
retail was just red selling across the board. It was pretty
You mean on the way
it's just
down?
how it work. Yeah, they were
You said on
selling
the
on the
way
way
down.
down.
They're
Yeah.
just selling stuff. Yeah. That's what
Oh
happens,
yeah.
man. Yeah. I mean, that's what happens, man, because people don't have conviction. Because people are just listening to me or you or anybody else, and they're just sitting there like they hear us say it and they expect it to just go gangbusters immediately. Which, I mean, it depends when you bought it. If you bought Oscar a month ago, you're up like 70, 80%. If you bought it, if you're fully in at like 18, then you're slightly up.
Yeah.
If you bought it at its highs at the top of the range, then you're down.
Yeah. I like every time,
Long-term
anytime.
investing. They call it long-term investing for a reason. I mean, I sit here and talk about technicals and everything, but I mainly talk about the fundamentals and where I see Zeta, Oscar going in the long term. I can't control the price action. I can't control what it does in the short term. Nobody can. But I will say this, based on Zeta and Oscar's earnings and where they're at, I do believe by the end of the year, they are a lot higher than where we are now. It's just you got to realize weak hands are going to sell. Wall Street will buy their shares, and then they'll start pushing the stock price up higher. And also, everybody's so infatuated with semis and everything right now, so everybody's selling whatever they can to go buy more semis. Do I agree with that? Heck no. You might get a little bit, but I'm going to say this for anybody out there that's listening. If you're not in semis right now, you missed it. You missed it. It could go higher. But man, like your risk is through the roof compared to the reward. So, but yeah, I think that's a good spot to stop it. We're already back up to 4% up. I'm gonna probably set some limit orders around that low, around like 17, probably like 1790, 1795. I'll set some limit orders to buy more. Yeah, but until after that, I do think now people were like, what are you talking about? El resistance and blah blah blah. Like I do think we could reject here and then come back down and have a significant pullback down to like the 9 EMA on the weekly. We could pull back into the 16s. I don't think anybody's ready for that. Like bullish wise. But we ran a lot, man. We ran a lot. So I think if you pull back, for me, I think it's a great buying opportunity. I'll be buying and then riding it to the top of the range. I do think we get to at least the top of the range this year, like 23, 24. I do think that. I think higher, but it's so dang hard to know when we're going to finally break out of this range, man. Because we rejected off that top like 3 times now, almost 4. It's tough. But said the same thing with Zeta. The fundamentals keep going up. The fundamentals keep getting better. Just focus on that, not the price action. Because the price action is going to price action. But great earnings. Good to join you. Good to be on here with you, man. Yeah, that's all I got. They crushed it, man. They crushed it and let people think what they want. But they just had a statement quarter. And now it's just let's keep building on that for the rest of the year. As long as they do that, then more and more people are going to realize that this company is a beast and it's very, very undervalued.
Exactly. Yeah. All right.
Cool.
Well,
all right, guys.
I took the morning off so I could be here for such incredible earnings. Now I got to go back to work.
Awesome. Well, have a great day, AC. Have a great day, everybody. We'll catch you guys next earnings. Take it easy.